Good afternoon and welcome to People Making Money, one of the Way to Wow shows. I'm your host, Kevin Bemmel, and we're here every Wednesday at 12:30 p.m. Pacific, 3:30 p.m. Eastern to talk about professional success and wealth building. And typically those two go together, unless, we were born with the proverbial silver spoon. I know I wasn't, and I suspect you were not either. In any event, today this ends up being today's show is going to end up being kind of an extension of a topic that was raised by my guest on Monday's show, Trust and Estates Weekly, Vaughn Marie Thomas, who's an accountant. One of her specialties is trust and estates, which is why she was on that show. And she was talking about financial statements, and because they really are the basis for understanding our finances. So we can't do financial planning, really. We can't do estate planning without having some sense of our financial position. And the way we do that is through financial statements. And so we're going to spend today's show talking about the two basic financial statements. One of them is the income statement, or sometimes called the income and expense statement. And that we're going to be looking at them, I should say, from a personal standpoint. So there are financial statements for businesses, and there are personal financial statements. So we're going to be looking at the latter. And like I said, the first one we're going to look at is the income statement, or the income and expense statement. For a business, that's oftentimes called a profit and loss statement or a P&L statement. We usually don't look at ourselves as sort of profit-making entities in that sense. So I'm going to be calling it an income statement or an income and expense statement. And then the other one is a balance sheet. Okay? And a balance sheet, so the difference between the two is an income statement is showing how our cash flow is going, our income coming in, our expenses going out at the end of the period, typically either monthly or annually. Is there anything left? Okay. And so are we cash flow positive or are we cash flow negative? So the income statement is showing our financial position over a period of time. Okay. A balance sheet is showing our financial position as of a specific date in time. And it's looking at our what are called assets. Those are the things of value that we own. Liabilities, those are debts that we owe, generally speaking. And then the balance between assets, or the balance after you subtract liabilities from assets, is something called net worth. So net worth is really what we own, if you will, or it's the value of what we the value of what we own. So let's say, we buy a car and the car costs $50,000 and we borrow $40,000 to buy the car. So $50,000 minus $40,000 leaves $10,000. Presumably that was the down payment we made. Okay, so at least at the moment that we bought the car has a net worth, or what's sometimes called an equity value, of $10,000, right? The car doesn't represent a value of $50,000 to us because we owe that $40,000 in the car loan, right? So we're going to be looking at these two, and they're going to help us understand what our financial positions are. So I'm going to go ahead and share my screen. Okay, here we go. All right. So what we're going to look at first, as I mentioned, is an income statement, or in this case, it's a monthly income and expense statement. Now, by the way, I could have done a second column here and multiplied everything by 12 and made it a monthly and annual income expense statement. There's many different ways you see these, and depending on what its purpose is, it may be monthly, it may be annual, it may be both. For most of us, we tend to look at our finances in terms of cash flow on a monthly basis. And so that's why I'm looking at this on a monthly basis. So, excuse me. Um, I don't know if this is, typical in that sense, but I'm making it a two-income household. Okay. They may or may not have a child or two. It doesn't really matter. The categories for the most part stay the same. But in it, while the general categories are just that general, they're the same. Your situation may require certain specific other categories. And so, you would add those in or take those out as necessary. I've just done this in a very simple Excel spreadsheet. Now, there are sort of bookkeeping programs, if you will, that will automatically generate financial statements. I know for myself, I use Quicken. Quicken's very easy to use. Full disclosure, I don't own any stock in Intuit, which I think is the company that owns Quicken. As far as I know, maybe in a mutual fund somewhere or something, but I get nothing for talking about Quicken at all. It's just it is the software that I've used for decades now. For a while, I used QuickBooks, and I QuickBooks is much more complicated to use for personal finances. I don't think we need something that complicated. I suspect now there are apps on your phone that will track things similarly to the way Quicken does. But one of my good friends, he just uses an Excel spreadsheet like this. So, whatever works. I mean, I think the main thing is we don't want to spend a lot of time doing this. And so whatever method you choose should be the one that you can use most efficiently. Okay, because if it takes a lot of time to do it, you're probably not going to. And so then that negates the value of having financial statements. Okay, so looking at the monthly income and expense statement, all these figures here in column B are monthly. Okay, so we start out with income. Okay, and the nice thing about Excel is you can do calculations in it. So in this case, salary earner number one has an annual salary of $85,000, which works out to about $7,100 a month. Salary earner number two is making $70,000 a year, which works out to about $5,800 a month. Okay, and then you'll see when we go into the balance sheet that there are some interest-bearing accounts. So they're throwing off about $26 a month in interest. So all told, this couple is earning just under $13,000 a month. Okay, so just to do an exercise here, we can annualize this. Star 12. Okay, so they're making about $150,000 a year between the two of them. Okay, and that's a pretty nice income for sure. All right, now sometimes you will see like if you find an income statement template, they'll just say like paycheck number one, like what is your paycheck. I don't recommend doing it that way because we're leaving out a whole section of our financial life, and that is the taxes that we pay. Okay, so your take-home pay, right, that paycheck, it's probably not in the form of a check anymore, right? It's probably being deposited directly into your checking account. But in any event, the money that's being deposited in your account has already had payroll taxes subtracted from it. Okay, so if you're making a salary of $85,000 a year or about $7,100 a month, you're not getting $7,100 a month deposited into your account. If you're an employee, your employer is required to make payroll tax deductions that are then sent to the federal government to make sure that you pay your taxes. So in most cases, you're going to be paying in payroll taxes Social Security and Medicare Oftentimes, those are combined into something called FICA, FICA, which stands for Federal Insurance Contribution Act. So that's the law that requires these deductions. And as I recall, the deduction for Social Security is 7.65% for the employee, and then the employer matches that. And Medicare is, I think, 2.9%, if memory serves. These may have changed recently, but they're around that amount. And again, the employer matches that contribution. Okay. By the way, if you were self-employed, so let's say you had your own business, okay, and let's say your own business generated income to you of about $85,000 a year, in your payroll taxes, since you're self-employed, and this is, by the way, you're self-employed, meaning in this case that you are a sole proprietor. Your business is not a separate entity like an LLC or a corporation. So if you were a sole proprietorship, these amounts are going to be doubled because you're going to have to pay what's called self-employment tax, which is basically the employer and the employee's share of Social Security and Medicare. Okay. So in this case, though, we're looking at a situation where the salary earner is an employee, and so the employer is paying half. All right. And then you're going to have a deduction for federal income taxes. Okay. And then you're going to have a deduction for, well, some states will have a deduction for state income taxes. And I'm going to stop sharing this for just a moment because I want to show you a website that I found. Okay, this is ADP is a payroll company. Okay, and they have a salary paycheck calculator tool that you can use. Okay, and in this case, you can plug in how often you're getting paid. In this case, semi-monthly, twice a month. Here's, in this case, the $70,000 a year, no overtime. Okay. And then it tells you what the deductions are. So if you're in a state, in this case, I plugged in Georgia. So Georgia has a state income tax. And this would be the income tax deduction for each pay period. So it's going to be twice that for the monthly deduction. Now, if we were to change this to the next door state, Florida, okay, notice there's no state income tax deduction, and that's because Florida does not have a state income tax. So you wouldn't have that. You wouldn't have that as a factor. And you can see here in this little graph, your take-home pay is, over 75% of your salary. Whereas if we go back to Georgia here, okay, notice that now take-home pay is just slightly over 75%, but it's a smaller percentage because of this state income tax deduction. Okay, and the nice thing about this is, well, okay, there you go. You can put your filing status. You can put, the number of personal allowances you have, if you have dependents, if you're going to take additional allowances, additional withholding, all of that you can plug in here. Okay. It also gives you, things about benefits, medical, dental, vision, healthcare, savings accounts, and that kind of stuff. So this is a really nice tool. I'll put a link to this in the show notes so that you can check this out if you want to after the show. So now, like I said, I just want to show you that so you can see the kind of tools that are available to do these kind of things. Okay, so now going back to our financial statement. Okay, so here's the deductions, for salary earner 1 for these first 4, and then salary earner 2, who's who's making $70,000 a year. So you can see the deductions are smaller because the person isn't making as much money. Okay, so in total, there's about $3,200 in deductions. Okay, against total gross income of about $13,000. So a little bit less than 25%. Okay, and again, that's because we're assuming they live in a state like Georgia that has a state income tax. So their net income, that's income after payroll tax deduction, is $9,700, a little over that. Now, by the way, you might have other types of payroll deductions besides taxes. So if your employer has a 401k plan and you have a matching option, so that may be deducted from your gross salary. And so that's not a payroll tax deduction, but that is a payroll deduction. Okay. And so again, that would lower this number. Okay. The idea is to figure out, what am I really, taking home each month? Because this is what I have to spend monthly in order to support my lifestyle. And let's get rid of this. Okay. Now, so that's the income side. And by the way, the income side could be much more complex. So maybe you own a rental property, okay, and you're getting rent on that property. Well, you want to be careful because you could plug the rental income up here, okay? But if you don't then plug in the expenses from operating that property down here, you're getting a false picture. So in a situation like that, what I recommend doing is do a separate income statement or income and expense statement for the rental property, and then you can plug in the net rental income. So we can do this real quickly here. We could just put in here net rental income, okay, and let's say it's $1,025 a month. Okay. So in that case, now, when you get down here, you can see your net income is higher, but you don't have to worry about this being inflated because the expenses were not deducted. They are. Okay. Now, expenses of owning a rental property, like if you own a house, let's say, and you rent it out. So you're still going to have to pay the property taxes. You're going to have to pay insurance. You may have some maintenance costs. Okay. Now, of course, the property taxes, generally speaking, are paid in 1 or 2 installments, not monthly. So you'll have to, divide the cost of the property taxes by 12 in order to get to a monthly net rental income. Okay. Recognizing that's kind of an average of your monthly income. Okay. And so this isn't truly going to be what you take home every month, okay, but that's all right. It's if it varies, a couple of $100 a month or something like that, that's not a big deal. What you want to avoid are big swings, $500, $600, $700 a month or more. Okay, all right. So I took the rental property out because when we look at the balance sheet, you'll see they have no rental property. All right, so we have a net income, like I said, of a little over $9,700. Okay, now we're going to look at the expenses. Okay. And again, these are typical expenses. So groceries and restaurants, I just plugged in $1,250 a month. It's about $300 a week. Here in Los Angeles, that probably isn't enough. Maybe it's not enough in other places because we've had some inflation in food prices and restaurants have had big price increases as well. But anyway, utilities. So depending on your living situation, now you'll notice here there's a mortgage payment. Okay, so this couple owns their own home. Whether it's a single family residence or a condo, whatever it is, they own their own home. So utilities are going to include electricity, water, sewer. If they have natural gas, maybe for heating or for cooking, that'll be included. Okay, so those are the typical utilities that they pay. And again, if this were Los Angeles, this is frankly way too low. But in any event, that's what's included in utilities. It used to be you might include telephone, but I don't think almost nobody has a landline anymore. So telephone probably isn't a typical utility anymore. All right, then internet service. Okay, I think what 75-80% of Americans have internet service, Wi-Fi, if you will. Okay, around $100 a month. Okay, some people have it with cable, although fewer and fewer people have cable. And you see, I have streaming services here, not cable, because I think it's much more common that people have, 2, 3, 4 streaming services, whatever they've got. Okay, telephone typically is cell phones these days. So, and this can vary. You hear about services that are, $50 a month per phone, but close to $100 a month is not unusual either. Okay, and then I put in, entertainment. This could be movies, plays, sporting events, whatever else, people do, for amusement, that would be under entertainment. Okay, and now we get into other, and with the exception of food, really kind of the more costly items. So auto insurance, right? It's a couple. They probably, or I'm assuming they both have a car. Okay, and so there's two insurance premiums. This may actually be a little bit high for monthly insurance premiums, although for California, no, it may even be too low. But in any event, I put in $541. Home insurance, $250 a month. That's $3,000 a year. That may be too low. Again, for California, it almost for sure is too low. Okay, mortgage payment, $3,500 a month. I'll explain to you how that works out when we go to the balance sheet. And then vehicle loan payments. So you'll see in a minute they have 2 vehicle loans, and then student loan payments. This is a couple. They already own a home, so they probably, with the kind of salaries they're making, one would imagine that they went to college, although not necessarily. A lot of trades pay these kind of salaries now: plumbers, electricians, those kind of things. But again, just to give you an idea of what kind of expenses generally you see, student loan payments would certainly be in there. Now, there may be other ones. You may have dry cleaning. I don't know. These days, I guess, most people don't even dress like I do with, a shirt, let alone a tie or a suit. So maybe they don't have dry cleaning or shirts to launder. But that could be another expense. They may have educational expenses if there's children. Just even if it's just, sort of books and supplies and that kind of stuff. If the child is going to private school, then, again, that could be a huge cost. And here in Southern California, private school can easily be $1,000 to $2,000 a month or more. I mean, top private schools can rival the cost of going to college. So that could be another big expense. You may have daycare expenses. You may have expenses related to your pets if you've got dog, cat, whatever, food and veterinary care. This is making an assumption too that they've got really excellent medical care, right? Because you see no medical expenses here. So presumably they don't even have a deduction or a copay. That's probably, unusual. These days, I would say, probably the majority of people have some kind of medical expenses, even if they have employer provided health insurance. And a lot of employers don't provide dental insurance. So there could be dental expenses. They also don't supply vision insurance. So there may be, glasses or contact lenses. So that's all there. Could be expenses for clothing. So there's lots of other categories that we could add in here, depending on your individual lifestyle. Okay. But this gives you an idea of, some typical expenses that you're gonna, the idea would be not to estimate them the way I did, but to actually look, what are we spending each month for groceries and restaurants? What are we spending for utilities on average each month? Okay, that is the benefit of a program like Quicken, is it will calculate your actual expenses. And in fact, you could, for example, you could look at all of 2022 and then divide those numbers by 12 in order to get an estimate of what you think they might be, might have been for this year, maybe adding some kind of inflation factor, 3, 4, 5%, whatever. Okay. So this particular couple, their monthly expenses are about $9,700. So when all is said and done, they appear to be living within their means. Good for them. Okay. So there's a positive balance at the end of the month. Okay. And that's good. Obviously, let's just say that their food bill is actually more like $1,600 a month. Okay, and let's just drop this a little bit. Let's drop this to 300. Okay, so in this case, they're going negative cash flow each month of almost $100. Right, that's not sustainable. Okay, because you'll see they have some savings, but over a 12-month period, if this is kind of like their average monthly, so we're talking almost $900, almost $900 negative for the year. And so when we look at the balance sheet, you'll see that that'll eat up their savings, pretty quickly, right? So they would need to make some adjustments. And that's the idea of doing this, is so you can see, hey, why do I feel like at the end of the month I'm always struggling? Well, evidently it's because this couple is spending more than they're earning, right? So now they can look at their situation. Now, one solution they may have, so this particular salary earner number one is paying almost $11,000 a year in income taxes, or I'm not paying, with having withheld almost $11,000 in income taxes. And salary earner number two is having withheld over $7,500. So between the two of them, 18, 19, about $19,500 a month are being withheld in federal income taxes. So depending on their tax situation, that i.e. they've got a mortgage payment, so a part of that is going to be deductible as interest. I didn't put in here that they have to make property tax payments, but the property taxes are also deductible. So it may be that they're having too much deducted in income taxes, both federal, maybe as well as state. Okay, so it may be that they need to adjust their withholding, and if they do that, then they won't be going negative each month, and they still are not, they're still not going to have a whopping big tax bill, when it comes time for them to file their tax return. Okay, so those are the kind of things that a well done income statement allows us to look at and analyze, both ourselves, and if we're working with a financial advisor or we have an accountant or whatever. So we can sit down with our financial advisor or our accountant, and they can look at some of these things and help us make some decisions so that we're on a sound financial footing. Okay, but without an income statement, we're really guessing what our cash flow is. Okay, and so it's hard to really make these decisions, and more importantly, stick with them. Okay, so especially in determining your expenses, I recommend, presumably, if you're paying them out of a checking account or you have them automatically charged in your credit card, and then you pay your credit card bill at the end of the month. I recommend doing this with as much detail as you can, so you can really see where your money is going, and then understand where there may be room to make some cuts if you need to. On the other hand, let's say that they were only spending $800 a month, a couple of $100 a month, a week on food. So now they've got a positive cash flow of $8,700. That's terrific. So what they might do is say, hey, you know what, we're going to take half of this, $350, and we're going to put that into an investment of some kind. And then looking at this, we're going to add another $100 for entertainment. And we're going to bump our food budget up by $50 a week. Oops, got to put a minus there, minus. Okay, and we still have our $350, more than our $350 left to put aside each month to build wealth. Okay, so again, this is the advantage of having a properly done income statement. All right, so now we're going to move from looking at our financial picture on a cash flow basis over a period of time to looking at a balance sheet. Okay, so in this case, we're doing a personal balance sheet. And by the way, balance sheets can be done for businesses. They're going to look, somewhat different for businesses, but they do work essentially the same way. Okay, and the thing about a balance sheet is it's done as of a specific date in time. So there's no such thing as a balance sheet for the month of November. Okay, that doesn't make any sense because the value of an asset on November 1st could be different from the value of an asset on November 30th. So, which date, or maybe it's November 18th. I mean, values of assets changes in some cases every day. Okay, as do things like loan balances. Not necessarily changing every day, but they they can change monthly, and so it depends. So you want to pin it down to the day. All right. All right. And you see here then the three categories: assets, these are things of value that we own; liabilities, these are basically debts, this is money we owe; and then net worth is assets minus liabilities. Okay. And by the way, when you see a number with a parentheses around it, that means it's a negative number. That's a kind of a standard bookkeeping term. I mean, and it's easier to see than if it had just a little minus sign in front of it. So that's why I've done it this way. And you also see here notes. So it's not unusual to have a notes column in a balance sheet if there's something that needs to be pointed out in order to make sense of what's going on. All right, so now let's go through each one of these items and understand what it is. So if it's a couple, even a married couple, not unusual for each person to have his own or her own checking account and savings account. So, I'm just matching, kind of like person one, person two throughout. So checking account, presumably you know what a checking account is. It's sometimes called a demand account. It's money flows in and out on a pretty frequent basis. It's sort of the ready cash that you have to pay your bills, as opposed to a savings account, which is more like kind of maybe a rainy day fund, if you will, and that's earning some kind of interest. Now, these days, a lot of people keep their savings account in a money market because the interest rates on money markets generally are higher than in a regular bank savings account. And so, but in any event, the interest thrown off by these savings accounts plus these taxable investments here, that's where we get the interest and dividends income here, right? That's why there's this additional income item. It's because the interest earned on savings accounts and taxable investments is taxable, hence taxable investments. Okay. So I just sort of chose numbers for these. The numbers could be higher. A lot of this is going to be a lot of a checking account balance is sort of personal preference. I know for myself, I like to keep at least a month's living expenses in my checking account, and I like to have another month's worth of payments in my savings account. That way I don't have to worry if I can pay my bills. So, by how I like my life to be, this is way too low because they've got, $9,700-$9,800 a month. And between the two of them, they've only got 26, 32, about 4,000. So they only have about half a month's bills, in these two accounts, but that's okay. I mean, this taxable investment, by the way, this could be a money market fund as well. Could be a money market fund, could be a mutual fund that's not in any kind of retirement account that's deferring the taxability. Okay, it could be all kinds of things. Probably not real estate, especially since the values are so low. But it's probably some kind of financial investment. Could be an ETF, an exchange traded fund. Most likely it's something like that. Okay, but in any event, the reason it's important to note that they're taxable is just that. So if it's a taxable investment, so this income here is going to be subject to taxation. Now, because it's so small relative to the gross income number, in fact, it's like 0.2% or something like that. So the income taxes being withheld, are probably going to cover this. So you don't have to really, worry about it. But if this number were higher, let's say this number was, $2,000 a month in interest and dividends. So that is likely to mean that if you're only having enough withheld from your salary to cover the taxes due because of the salary you receive, you'll end up paying taxes on this when you file your return. So you have a couple of options. You can increase your withholdings to cover this, or you can just write a check when you submit your income tax return if necessary. And that has to do with your financial philosophy. Do you want to loan the government that money, which is essentially what you're doing with payroll tax deductions, or do you want to just make sure that you've got that money accumulated so when you need to file your tax return, the money is there to make the payment? That's up to you. Okay, so we've got taxable investments. Next, you see there that one of them has a 401k plan. This must be some kind of retirement plan that their employer sponsors. And another one has an IRA. So this is something that they're, probably self-funding, maybe because their employer doesn't have a retirement plan or something like that. Okay. Next, you see a personal residence. $875,000. So that's pretty expensive. Now, the reason I put it at that is they're paying $3,500 a month in a mortgage payment. That's $42,000 a year, assuming they got the loan, a couple of years ago. That means that they're supporting a mortgage of about $700,000. Okay, so if even if they bought the house with no money down, which they probably didn't, the house is probably worth somewhere in the neighborhood of about $875,000. It's unlikely that it went down in value, although it might have, but more likely over the last couple of years that it went up in value. Housing prices have been increasing. Okay, so this is their one very substantial asset. Okay, and then we mentioned each one of them owns a vehicle. And I just plugged in some numbers, and you'll see in a minute, I plugged them in based on the fact that, most of us, are upside down in terms of car payments, especially if we got 100% car loan. Okay, so you're going to see that that's the case in a minute. All right, so altogether, they've got $990,000 in assets. And you may be thinking, wow, they're a millionaire, right? Not yet. Okay. So now let's look at liabilities. These are the debts that they owe. So they've got some credit card debt, just a little bit. Now, in my case, I look to pay off my credit cards at the end of each month and not carry balances. And if that's typically what you do, you pay off your balances at the end of each month. So, you may not show any credit card liabilities here. But that's again, it depends on what date you're reporting, and how much these are. So you'll notice, by the way, there's $3,000 in credit card liabilities, but their checking account balances together are about $1,500. So it would appear that these must be small balances that they're carrying. By the way, they would be much better off paying off these balances because of the interest rates that credit card companies typically charge on carrying a balance. But we'll talk about things like that in a few more minutes. Okay, here's their mortgage. Like I said, I assume they borrowed about $700,000, so they've paid a little bit of that off, not a whole lot, but they got a mortgage balance of a little over $650,000. Okay, vehicle number one, I pegged at a value of about $24,000. I mean, sorry, the vehicle loan number one has a balance of $24,000 about, which is higher than the value of the car. Again, not unusual. Vehicle loan number two, the loan amount is about $39,000. We're even farther upside down. So it sounds like, these are not cars that, retain their value. I just did that to make a point, and that is that when you get a 100% car loan, pretty much the moment you drive the car off the lot, you're going to be upside down in your loan, meaning the loan balance is going to be higher than the value of the car. Okay, that's just, most cars take a big depreciation hit the moment they're not brand new. Now, over time, the loan balance will go down, and the rate of the decline in the value of the vehicles will slow. So the decline in vehicle value tends to be steep and then level off. Okay, whereas the payoff rate of a loan tends to be slow, and then it gets steeper the longer you pay it off. So they're kind of going. Well, if this is the loan balance, and this is the value, so they're kind of going like this, if you will. So in any event, that will eventually, eventually these loans will be paid off with 3-year, 4-year, 5-year, 6-year, something like that. And then whatever those vehicles are worth, will truly be an asset. Okay, and then finally, they have school loans, about $100,000 in school loans between the two of them. Again, we mentioned that, there are student loan payments. To be honest, I don't know if this loan payment amount correlates with $100,000 in student loans. Maybe not, but in any event, since there's a student loan payments, then there must be student loan debt. So their total liabilities are about $823,000, which means their net worth, or what we might call the equity they have in their lives, is about $167,000. So really, like 17% of the value of their assets. And in fact, we can actually calculate that out. Let's take a look at that real fast. Okay, and yeah, there you go. I was pretty much spot on. There you go, 17%. Okay, so and that's fine, especially if this is a younger couple just starting out. So over time, they're going to pay down their car loans, they're going to pay down their student loans, they're going to pay down their mortgage. So this number is going to decrease, and hopefully these numbers are going to increase. That's what we call building wealth. Okay, these numbers may decline a little bit, but unless they hold the car to the point where they're really junkers, so these may decline by 50%. So between the two of them, 48, maybe they're worth 24 between the two of them. But if at that point the loans are paid off, that's going to be a big boost to their net worth. Okay, and hopefully the value of their home will increase, maybe not as rapidly as it has the last few years, but hopefully it will continue to increase. So maybe 5 years from now, the house is worth $900,000, whereas the mortgage mortgage balance is maybe down at that point to $600,000, and so now they've got a $300,000 in equity, in their home alone. So that will significantly increase this number. Okay, and same with their school loans. Eventually those will be paid off. Okay, so again, this gives us a picture of where we're at in terms of our wealth, if you will, at a given point in time. Okay, and that's important because it helps us make certain decisions. So I mentioned a few minutes ago, we've got two credit cards. It appears that these are balances. So there's $3,000 in credit card balances. They're probably paying somewhere between 18 and 24% interest on these credit card balances, whereas on their savings accounts, it's unlikely they're getting much more than 4 or 5%. So they're paying a net interest gap of somewhere between 13, maybe as much as 20%. So it would be much smarter, even though it'll use up this money, or use up all of this money. They'd be much smarter paying off balances that they're carrying, rather than holding these, especially if these taxable investments here are relatively liquid, meaning if they have an emergency, they can get some cash out of these investments without sacrificing the value of the investments. Meaning, if they need $2,000, they can get $2,000 out of here. It won't be, they won't have to pay a penalty. So it costs them $2,500 to get $2,000 out. Okay. Now, if these are the kinds of investments where they have to sacrifice some value over and above their cash needs, so then maybe that would justify continuing to carry these, so they do have at least some liquid funds. Okay, but if that were the case, let's go back here. Remember, we were saying they were looking at their overall picture, and they've got, in this case, over $400 a month in sort of free cash flow. So the smart thing to do then would be to take that $400 a month, and over the next roughly 7.5 months, pay this off before they start saving the additional $400 or $350 a month. Get rid of this credit card debt, because the reality is there's really no place where they can invest this money and get an interest and get a return on it, an interest rate or dividends or whatever, that's going to come close to the interest they're having to pay on carrying credit card balances. Okay, so those are some of the trade-offs that we can examine, again, when we've got this overall picture of our financial worth. Okay, and then we can also look at other things. So so far they've got about $40,000 saved towards retirement. Okay, they've owned a house. Eventually, although most people don't do this, let's say they bought the house 3 years ago and on a 30-year mortgage. 27 years from now, the mortgage will be paid off, and who knows what the house will be worth? Maybe $1 million, $1.2 million, who knows? But now they've got a place where they can live mortgage free. So all they need to pay are property taxes, insurance, and maintenance. And assuming they've kept the house up over the years, they've got maybe some routine maintenance with an occasional big maintenance item. But certainly that's probably going to be, less than, $3,500 a month. Okay. So that plays into what they need for retirement. Okay, so then they'll keep building this up so that they've got money to pay for these expenses. Let's see, like from the 250 up. So this is what they need to replace in a retirement income, because the mortgage is paid off, the vehicle loans are paid off, the student loan payments are paid off. So notice if they were to pay off these three, 35, 46, 56, 64. So they'll pay off 2/3 of their monthly expenses. And so to maintain their lifestyle, they only need about $2,500 to $3,000 a month. Okay. Now you might say, well, wait, they're retired, so they're going to want to travel. Of course, of course. Okay. But so maybe instead of needing, $9,300 a month, maybe they only need, $6,000 a month to live the lifestyle they want. So then these retirement accounts need to build up to the point where they can generate $6,000 a month. Okay. And that can all be figured out. And it's one of the reasons why you want to have an astute financial advisor. They can help you figure out these kinds of things. Okay. All right, and let's see, is there anything else I want to mention? No, so that's really it in terms of financial statements. So just to review, again, real quickly, an income statement is looking at income, inflows over a period of time, in this case, monthly. It's looking at outflows, we call them expenses, to figure out what is our balance each month. Is it positive? In that case, we have a positive cash flow or a negative cash flow. And again, it's over a period of time. Could be monthly, could be annually. Those would be the two most common. Okay, a balance sheet is, sometimes you'll see another type of financial statement called a statement of financial position. That's essentially a balance sheet. It's a fancy way of saying that, okay? And this is a financial snapshot of our life as of a particular date in time. It looks at our assets. Those are the things of value that we have. It looks at liabilities. These are debts that we have, things that we owe to creditors, other people, whatever. And what's left, the difference between the two is our net worth. Now, let me show you one more thing before we close. Let's say that each one of these people have really massive credit card debts, okay, such that their total liabilities are over $1 million. Okay, notice their net worth now is negative roughly $30,000. Okay, that means if they sold all of their assets or liquidated all of their assets and they were able to get $990,000, they still would not be able to pay off all their debts. Okay, now that doesn't mean that they're bankrupt. Okay, bankruptcy is a legal process. Okay, but let's say that both of them lost their jobs and now they have their income goes to zero. Okay, well, they still have all these expenses. Their mortgage lender is going to expect to be paid. The vehicle lenders expect to be paid. The student loan, they may qualify for a deferral. They may get no entertainment. They may have to cancel their streaming services. They probably need their cell phone and internet. If they're job hunting, they're going to have to pay for utilities. They still have to pay for food, right? So, and let's say they struggle, probably not in today's market, of course, job market, but let's say the job market was really bad and they struggle for a long period of time. At some point, they may have to file for bankruptcy. And at that point, their creditors might have to take a little bit of a haircut, meaning they won't quite get all the money that they're owed. Okay, so the mortgage lender, they're going to get what they're owed. The vehicle lenders, they're going to repossess the vehicles. The student loan, that has to be settled in the bankruptcy, as do the credit cards. So, we'll probably, what would happen is they'll come out of bankruptcy owing nothing. So this negative net worth is probably not going to follow them. It may, obviously, I'm just talking generally. It would depend on the person's exact situation. I'm not giving any legal advice or anything like that. But the idea of bankruptcy is that when you owe more than you have in assets, bankruptcy gives you a clean start. So hopefully this negative net worth or the debts equal to this negative net worth would be what's called discharged in bankruptcy. And, they start over again. And unfortunately, sometimes that's what we have to do. Okay, well, that is today's show's today's show on financial statements, the two basic personal financial statements. So I hope you found this useful, because again, as we deal with our professional success, and by the way, this is not to suggest that the only measure of professional success is financial. I don't believe that. I think there are several measures of financial success. Having said that, I do believe that financial success is a significant part of professional success. Now, for younger people, many of them don't value financial success over other aspects of professional success. So, look, we each have to make that decision on our own. Nonetheless, we have to have money to live, okay? And we have to make decisions about what is our lifestyle going to be, and can we afford our lifestyle, right? So that's why doing an income statement is so important, so we can figure that out and hopefully live within our means. And then, if assuming wealth building is important to you, and I imagine it is because you're watching this show, right? So the balance sheet is really what tells us how much progress we're making in terms of building wealth. Okay, and that's how we determine, are we getting closer to our objective? Are we losing ground? And it will fluctuate over time. The value of assets changes. Look at the stock market, right? It goes up one day, down the next, up for a week, down for 2 weeks, whatever. Okay, so all of that can be taken into account. Okay, we don't need to be doing these financial statements every day. Certainly not. Once a month is absolutely adequate. In some cases, maybe we only need to do them once a quarter. Okay, if our situation doesn't really change that much. Okay, but to the extent that we have important financial goals, these are the tools for tracking them, so we know where we're at. So that is today's show. I thank you for joining me. If you would like a copy of these financial statements to kind of play with on your own, by all means, send me an email or just post something on social media. Well, actually, don't post on social media, because I don't want you to post your contact information on social media. But you can send me a direct message on social media. And I will, I can send it to you through there, and help you get started. If you have any other questions, comments, again, always feel free to drop those in social media. Happy to answer those. You can also email me if it's something kind of private. By all means, of course, I'll keep it confidential. So thanks very much. This is our final show for this week. So next week on Monday at 10 a.m. Pacific time will be the next edition of Trusts and Estates Weekly. On Tuesday at 11 a.m. Pacific time, the next edition of Business Lessons from the Military. And then 7 days from today at 12:30 p.m. Wednesday of next week will be the next edition of People Making Money. So I thank you very much for joining me. Wishing you a wonderful rest of the day and the week, and a restorative weekend, and signing off. Marie, you are my bell. All the best, folks.